Welcome back to the Investing on the Go podcast, brought to you by Fund Caliber. This week, we're considering one of my favorite topics, investor behaviour, both rational and irrational. From the shunning of UK equities to the polarizing topic of Japan and property, today's episode is a great look into the emotional volatility feeding markets today.
I'm Chris Sarley, and today we're joined by Stephen Andrews, manager of the elite-rated M&G Episode Income Fund. Thanks for joining us today, Stephen.
No problem, Chris. Nice to see you.
Been a while since I've spoken to you. I think the last time we talked, we spoke about Mike Tyson and the idea of the everyone's got a plan until they get punched in the face, and we use that to describe emotional volatility and irrational behaviour. I might be retired from the ring, but he's been throwing a few punches to investors in 2023 and the back end of 2022. Are you seeing a bit of the emotional volatility in the markets at the moment? Is it at a peak? How are you sort of perceiving things in the last?
I think, it's a really good starting point here, because we all had such a rough experience of 2022, and then you come into 2023 with investors feeling pretty beaten up, and if not on the deck, just kind of in the mood for the ref to get you back to the corner and get the towel out and flap it around your face, just so that you feel a little bit more energized. So we enter into the new year, and markets actually start to cheer up. Markets actually start to say, well, you know what, maybe the future isn't as bad. And that, I guess, there's been partly a reflection of things just got so bad and so challenging in 2022 that there was an element of a relief rally. So there's an extent to which you can't really project that too far and extend it too far. But then there's another extent in which it's reasonably rational, because the stuff that we look for are things that can't easily be explained by the facts. But the facts, to be fair, have been by and large better than people had been expecting. Economies haven't slowed down to the degree that they were expected to. And so some of the data has been quite supportive. So in that sense, it's not something that I've wanted to fight against in that way. So it doesn't feel as if it's something that's been overwhelmingly driven by an emotional or behavioral response. It feels like a fairly coherent response to saying, right, well, that data reassured me that stuff isn't deteriorating very quickly. And so it's reasonable to say things might be better than we expected. Now, where we've moved to is on the fringes of a bit of complacency, on the fringes of saying, well, hang on a sec, the longer run here, you've had what would be called the sharpest tightening in monetary conditions. So the biggest whack from interest rates in 40 years. It's very unlikely that you get out unscathed from that. So what we can interpret the experience of the first quarter or the first part of it would feels more like a bit of we get a bit of a rest. We get 3 minutes rest before the next round starts, but we need to get ready to get back in there, because it will remain volatile. There will still be opportunity.
We'll get back to Mike Tyson and outlooks, etc., and how we're going to weather his punches in a bit. Can we maybe talk about the UK? You mentioned sentiment. Mm-hmm. Everyone hates the UK, but you've got a bit of an allocation to them. Are they a bad investment? Are they a contrarian investment? Or is it a case of simply waiting for the sun to shine in the UK?
I think so. So why is everybody gloomy about the UK? Again, that feels like a fairly rational level of gloom, given where the fundamental economy is facing. So you have the lowest growth and the highest inflation mix. That's an unpleasant mix. And you have a policymaker that's still facing towards tighter rather than looser. Now that can change. That can absolutely change reasonably quickly. So despite what I would say in the UK's favour would be, whenever you see this sort of clustering of misery, you see the clustering of pessimism, you don't really have to have a very different view to say, well, the chances are you might get surprised on the one side of things. Is the UK going to be even worse than everybody expects? Or might it be not so bad as everybody expects, or at least look not as bad as everybody?
Over the last few years, we've had that valuation versus history chart, and it seems to be getting bigger and bigger. Eventually, at some point, it has to become attractive, doesn't it?
It does. And to an extent, the UK's hampered a little bit by the fact that it's shrunk in the global economy, in the global market. It's halved the UK's proportion of the global market, the all country world index, has pretty much halved over the past decade. So in that sense, that a reasonable benchmark allocation to it is now 4 or 5%, whereas 10 years ago it was closer to 10%. So in that sense, there's less of a structural appetite for the UK anyway. But absolutely, that doesn't mean that might mean it's a more easily ignored market. So yes, there might be more excitement there. From a fundamental perspective, I would say there are a few things that you'd really want to see in place. You'd want to see the visibility of the end of the tightening cycle. You'd want to see some of the fundamental macro data start to improve a little bit. And I think we've still got a bit of a painful journey to go before we get to that stage.
Okay. I'm going to talk about a couple of other asset classes in a minute, but just to stick with equities, obviously you seem to have a bit more of exposure to Japan, Europe and US. Maybe just give us a quick line on each of those and what type of companies you're looking at there.
Sure, absolutely. So let's start with Europe at the top of that. So Europe has had a thoroughly miserable time, miserable pandemic, miserable post-pandemic, and it's only really quite recently become, if not flavour of the month, much more highly regarded or much kind of less poorly regarded than by global investors. So attention has turned away from the US as an aggregate, overvalued market that everyone has been concentrated in, to one that says, well, you know what, areas outside of the US look more fundamentally well supported, and moreover, they're cheaper. So the thing in Europe's favour has been, up until recently, it's been pretty cheap. Pessimism abounds, so everyone's been facing in the same direction. So our allocations to Europe, they were concentrated in the bank sector. So that was while the market was still adjusting its interest rate expectations upward. You had some solid balance sheets to the European bank sector, as incidentally you do in the US and in Japan. And it's a theme in the portfolio to have participation in those global banks. The area that caused, and oftentimes you get this, the area that caused the harm the last time is the one that's done the repair and is still in an era of kind of distaste. So when the market isn't really wanting to pay up for things in that sense, banks remain good value and are growing their earnings. So whether they're in Europe, Japan or the US.
Are they a good sort of, example of what you're doing, banks? Because, it's 15 years since credit crunch now, and the sentiment still seems to be negative on them, despite the fact that they're in a totally different position to what they were going into that in terms of capital allocation. It
is. And that just shows, I guess, from a human perspective, that just shows how long it takes some scars to heal. Given the profound nature of the financial crisis, the queues around the block of Northern Rock, people hoarding cash, worrying about the collapse of the system of capital that people had operated under. These were real and plausible, and they were making films about it, for heaven's sake. So in that sense, it takes a while, and it certainly takes a big cycle. So every cycle up to that point, and we've discussed this before, every cycle up to that point relied upon credit. Further credit expansion, then you got to the end of the road and pop, something went.
Yeah.
This time it's different about this time is you've not had that big explosion of credit. So you've got some solidly financed banks that aren't overextended in any way, who are growing their earnings, and they can do that much more easily in a higher interest rate environment than they can in a zero interest rate environment.
Just quickly before we move off equities, we talked about the Europe and the US and a little bit on Japan. Can we get a bit more on Japan? It seems to always polarized opinion, but there seems to be a growing sentiment towards the region.
I think there is. And also in Japan, that's where we've got a broader equity allocation. So it's not just the banks, only got a couple of % in banks. The majority of the holding is spread across that real economic exposure in Japan, where we have seen an element of insulation from some of those global headwinds, particularly around the inflation chasing, inflation punishment, the cost punishment loop that the more Western economies have gotten themselves into. So there does seem to be an idiosyncratic Japanese element going on. So yeah, we want to make sure we're engaged with that.
Let's touch on a couple of other sectors before we go to sort of the outlook and forwards. First of all, property, no allocations there. Is it the same reasons as most? I mean, just give us a couple of lines on what you're sort of seeing as the main.
Two big. Well, the two main factors, one, liquidity, second would be fundamentals, essentially. So the things that we'd look for as a sort of global multi-asset, you want to make sure that you have enough liquidity, in the sense that if something shocking happens in one area of the market, that you can sell down certain other areas to go and exploit whatever that opportunity might have been presenting you with. With property, I don't really want to treat it like that. It's a different asset class that has a longer term payoff. It has its role from time to time within a multi-asset portfolio, to be sure, but not at a time when we want to remain as nimble, where it doesn't pay us to have really high conviction views at the moment, because thinking that you know what's around the corner, particularly right now, feels like a pretty perilous thing to be doing. So at the moment, no thank you. But if we have better valuation, if we have a clearer sight of that global market outlook, then absolutely we could in the future have some property.
Okay, and lastly, in terms of sectors, bonds, I mean, we've gone from a sort of shop of dearth with nothing on the shelves to a sweet shop almost. You know, you've got some emerging market bonds and a bit of high yield. I mean, I'm almost tempted to ask you, why take the risk if we're going into global recession? You're getting quite good returns in investment grade. So just tell me why you're sort of, I don't want to, the term that comes to mind is sort of going extra mile. Well, tell me why you feel.
Yeah, why bother? I know exactly what you mean. Yeah, absolutely.
Sleepless nights. Why give you the sleepless nights?
Well, it does get to the heart of diversification, and it gets to the heart of what being a kind of global multi-asset portfolio. So in a portfolio context, while certain entities wouldn't be all you would own, because you're right, going into a global recession, customarily, you would think, well, those guys usually suffer quite a lot if you're in a global recession. But let's wind it back a little bit and see what the journey has looked like so far. The central banks in many of those emerging markets were quicker to tighten interest rates, quicker to see through the inflation. So inflation rose, started to come down again, and are already further along that journey than the Fed, the Bank of England, the ECB. And that has also been manifest in the price of those bonds. So the price of their bonds has already fallen and the yields have sold off. So there's a great deal already in the price. And the further reason would be, one of the reasons why these areas have sold off in the past during a kind of global downturn, and the dollar would be strengthening at that time. Many of their liabilities are in dollars, so they have bother funding themselves. And so there's a bit of a doom loop that then gets created. In a similar way to the post-financial crisis recapitalization of the banks sector, you've seen a much less vulnerability about the funding of emerging market nations. And so in that sense, you don't have that kind of itchy trigger finger that says, whoops, these guys are vulnerable if the dollar goes up. We've already seen the dollar go up and they were absolutely fine, because a lot of their funding is now done in local currency rather than in foreign currency. So in that sense, there's greater resilience and there's a lot in the price. So we want that diversification. And
in the high yield side, is it a case of, obviously the yields are attractive, like high single digits in certain cases, but also, you know, the market's matured a bit. You know, it's not, I think I read somewhere that triple C were a lot larger allocation to the market. Now it's a lot more mature, fewer defaults, etc., etc.
It is, yeah. And as you know, we've always trod lightly in credit. It's not something that, as again, the features that you want, a liquidity, dynamism, and that's not always the home of credit. If you want to be in a hurry, it's not really the place to be. So we want to calmly engage with these areas. We've seen a really quite substantial restoration of value in the credit market, not just high yield, but also investment grade. And we have stepped into that, but it's a stepping into that we're doing on the basis that it's more of a strategic ownership than it is to say, yeah, they're going to make us some money this year, or they're going to make us some money in the next 6 months.
So just briefly, could you maybe tell us about the fund's positioning and what you think is relevant or unique for investors?
I think in terms of it's about the dynamism. So it's about being prepared to act amid volatility. And that can sometimes be a painful thing to do. And it can always be a painful thing to do, frankly, because if it feels good, you're probably getting it wrong, because it feels like everyone thinks you're popular, everyone thinks you're making a winning call, and then that's very consensus. The real challenge is when the market is huddled in one corner certain about things. And when, as we know, as in life, if you have too much certainty about things, then you're ready for a surprise. You should be ready to be disappointed in some way, and other factors that can come left of field. So in that sense, it's about that vigilance and understanding of the volatility and the breadth of opportunity set that we can look at.
I'm going to finish by sort of going back to Iron Mike. He's getting back off his stool for the next round. Could you maybe give us your view on markets for the rest of the year? Should investors be ducking and diving? Do you expect a lot more opportunities from this sort of emotional uncertainty and volatility in markets?
Yeah, if not, yeah, I mean, when we think about, so as a general principle, when we think about any of this stuff, we can't lose sight of, or it's really important to have in your mind all of the time, what are these prices trying to reflect? They're trying to reflect the real economic policy fundamentals. So we have been through the single most kind of resonating shock, both to real economies, society, financial markets. Then we had an enormous policy response to that. All of that, at the very least, messes up your data. Yeah. Equally, it messes up the pushes and the pulls of policy in the real economy, causes changes in the labour market, causes changes in society's behaviour, in its consumption and credit patterns, all of that stuff. And what has tended to happen in the past, or a very long period of time, is bouts of fundamental volatility then are followed by more fundamental volatility, because you overshoot, you undershoot, you overshoot, you undershoot, until you get back to some kind of equilibrium. So when we think about that, and we think about what the market's reflecting, absolutely yes, you're going to get overshoot and undershoot in the price.
Do you think there's an element of confusion because it's been, a couple of decades at least since we've had a traditional recession and not some sort of crazy hard landing beyond belief? And that's also going to cause a lot of sort of emotional uncertainty.
There is. And you would say people have lost their anchor. So we've lost an anchor. We don't know what home looks like. We don't know what normal looks like. And amid all, and of course, there's so much that we normally don't know, but we think we know certain things. But now even the things that we thought we knew, we got to throw those out as well, because we might not be right about that. So yeah, absolutely. And that, again, begets volatility in price behavior.
Okay. And just lastly, obviously, we've talked a lot about how you sort of operate the fund in terms of taking advantage of those behavioural finance opportunities. Mm-hmm. If you were to give our listeners one behavioural finance tip, or how they perhaps could use it in their portfolio that's prevalent, it's always prevalent, but particularly now. Yeah. What would you say?
Well, I would adopt that general rule that says you're looking at prices. Let's not forget what they should be reflecting. They're reflecting the nature of the world. What do we know about the nature of the world, or the economies or companies or whatever that might be? We know it's uncertain, and we know it takes its time to change. Rarely do these things change very, very quickly, i.e. days and weeks. Usually they take longer than that. So if you can see in price behavior a contradiction to that, so if you see price behavior and everyone talking about the same thing and everyone being confident about the same thing, i.e. too much certainty. So if there's too much certainty of recession, there's too much certainty of growth, if there's too much certainty that the Bank of England's going to do this and that, there's the time to step back and say, well, hang on a minute, where's the opportunity amid this certainty? So that's one thing. The other thing would be if prices are moving really quickly. So if prices are moving really quickly and you can't find, and you shouldn't have to look very far because it should be blindingly obvious. If you can't find facts that support that, and it's just a made up story that supports that, alarm bells should be ringing there. And on the upside and on the downside, the flag that says you might be interested in buying this should be raised. So I'd say that those are the two aspects. But generally speaking, it's when markets lose sight of what they're trying to reflect.
Stephen, once again, thank you very much for your time today. It's great.
Not at all. It's a pleasure. Nice to see you.
The M&G Episode Income Fund is a multi-asset fund that invests directly in individual stocks and bonds, as well as property funds. This interview demonstrates how Stephen uses behavioral finance to find pockets of value to invest against the herd. The use of the word episode in the name of the fund is to reflect the periods of time when investors' emotions cause them to act irrationally and provide these attractive opportunities. For more information on the M&G Episode Income Fund, visit fundcaliber.com. And don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on Fund Caliber's research methodology and are the opinion of Fund Caliber's research team only.